Good day, participants. Today we will be studying chapter number 15 of the subject Risk Management and Insurance Planning. Chapter 15 is about implementing and reviewing clients' insurance. We have various subtopics in this chapter. The first subtopic is advisor as first line underwriter in completing application forms, frequency of review, establishing and implementing changes. Then we'll be studying about how to handle claims and complaints and what do we mean by ongoing review. Now, let us understand why this subtopic is there, advisor as first line underwriter. As we know, what is underwriter? Who is an underwriter and what is underwriting? We have studied it in the earlier chapters that underwriting department is that department which assesses the risks from the proposal forms and from the other documents submitted by the proposer and by the life person whose life has to be insured. So, therefore, the people who are working in the underwriting department or the people who are directly responsible for finally assessing the risks are known as underwriters. So, therefore, it's a separate department, and the people who work in underwriting department are specialized in assessing the risk. They have to have some knowledge of medical diseases also, about medical terms also, and sometimes they, along with a medical professional, come to a conclusion whether to accept the proposal at standard rates or whether to levy an extra premium on the person, or whether to give the insurance on the same terms and conditions, or whether to alter the conditions. For example, there can be various permutations and combinations while offering a plan. Insurers have the prerogative to offer the plan on its standard terms and conditions, or they can reduce the sum assured, they can even reduce the term. They can also tell the person that no, this plan won't be given to you. Instead of the whole life plan, you take an endowment plan for say 20 years or 15 years. So you take a term insurance plan instead of a whole life plan. So there can be different permutation and combination. And at the extreme form, they can even reject the proposal. They can refuse to give an insurance cover to a particular person. So there are different permutation and combination, but all those decisions are arrived at after doing numerical rating, after applying all numerical rating formulas, and after a scientific process, basically. So it's a underwriting process. When we say that advisor or agent advisor, or the person who would be selling the insurance plans to the customers, should act as a first line underwriter. First line underwriter. Or we say that advisor should act as a first line underwriter, or in other words, there is another saying where we say that advisor is basically a primary underwriter for the company. Now, what does this mean? Technically, we say that advisor is an underwriter. No. Technically, advisor is a salesperson. So, advisor is not an underwriter, but as a proverb, we say that advisor is basically a primary underwriter or a first line underwriter. Why we say it so? Because there are certain facts about the person whose life is going to be insured. Those facts and figures are known to the person himself or herself. And it is the advisor or the agent who personally go and meet the prospective customers or the prospective buyers. He can understand their lifestyle, he can understand any physical hazards faced by them, or he can inquire or know about any occupational hazards associated with them. He can also sense any kind of moral hazard behind taking an insurance. Basically, he is physically meeting the people, so he can get first-hand information quite easily, rather than the people, or rather than the real underwriters who are sitting in the office. They don't have access to the person. They would have to assess the risk on the basis of the documents submitted to them. So, therefore, being an intermediary, this is the duty of the underwriter. This is the duty of the advisor. Since advisor is the representative of the insurer, advisor is getting his commission from the insurer. So, advisor is bound to act to the benefit of insurers as well as to the insured. Therefore, he is supposed to reveal any such facts regarding the proposer to the insurer, to his principal. In turn, he is also helping his clients, because in case if he do not reveal the real facts about the proposer, basically he is harming the interests of his clients, because at some point of time, if unfortunately some risk happens with that particular client, and then some misrepresentation or some fraudulent means is known to the insurer, and insurer comes out with a proof, then the claim would be rejected. to the dependents of the client. So the dependents of the client will in turn blame the intermediary who was responsible for getting this plan through. So therefore he is rather harming the interest of both his principal as well as his clients. So therefore this is the duty of the advisor to reveal all this information, and this information is revealed in agent's confidential report. Any agent or agent advisor has to fill up an agent's confidential report, and he has to write his own findings about his own observations about the proposer. And he is also supposed to get the proposal form filled in the true spirit, and he should ensure that all the information which has been filled in the proposal form by the proposer or by the life assured, it is filled in truth. No facts should be concealed. No fact should be concealed in the proposal form, because as soon as the proposer signs the declaration form, it becomes a warranty. The declaration becomes operational, and the principle of utmost good faith becomes operational. So tomorrow at a future point, if some other fact is known to the insurer that this particular fact, this material fact was not revealed by the proposer at the time of signing the proposal form, then the utmost good faith, according to utmost good faith, his policy can be even considered as void ab initio or null and void. So therefore, proposal form, if we talk about, proposal form contains all information required to assess the amount of cover that can be given to the proposer, and it contains information about the nominee to whom the payment will be made in case of death of policyholders during the term of the policy. So therefore, advisor is supposed to advise his client about nomination, whom to make the nominee basically, and to suggest that who can be made a nominee, who cannot be made a nominee. Now, if we talk about completing application forms are nothing but proposal forms. In insurance, proposal form is a kind of an application form. So proposal form will contain all details about the name of the life assured, name of the proposer. Sometimes the life assured and proposer can be one and the same person. Sometimes they can be different person. Proposer would be the person who can propose for the life assured. Both the proposer should have an insurable interest in the life of the life assured. So therefore the age, any past medical history about the occupation, about the salary, income, etc. all have to be revealed in the right spirit, and any other information which the proposer or the life assured feels that it is relevant to the risk being covered, or which is material. We call such information as material information, because material information is that information which can affect the judgment of a prudent underwriter to take an appropriate decision regarding the acceptance of the policy or rejection of the policy, and regarding and in deciding the terms and conditions of the policy. Now we come to the next subtopic of this chapter, which is about frequency of review. Now the advisor should endeavor to review the insurance coverage required by the client from time to time. For example, today the advisor has been able to convince the client that yes, he needs a sum assured of say rupees 5 lakh. Now after say 3 years or after a span of say 4 years, the client's financial position may undergo a change. In most of the circumstances we will see that the client's financial position would improve. A professional job, or he's in any other profession, if a person is bound to progress with the passage of time. So if his financial position improves, so therefore he may need a larger sum assured. At the same time, a person's family also grow. A person might have been a bachelor or might have been just recently married, and then afterwards he will have more dependents, maybe children. So then again the personal situation would change, so there would be a need to review the amount of sum assurance. So there would be a need. So advisor should also continuously keep on monitoring the amount of sum assured required, and in the meantime there may also be a change in the other material aspects of the client. For example, health, for example, physical position, medical health history, occupation. In light of the new changes, the advisor has to constantly review these things, and in turn may advise any other new insurance to the client. Now, when we talk about underwriting, in underwriting also, when the proposal goes to the underwriting department. The underwriters undertakes two kind of underwriting. One is medical underwriting, major form of underwriting, and the other is financial underwriting. Now, it's not necessary that each and every proposal a medical test would be required to be done on the life assured, because whether to conduct a medical test or not would decide on the sum assured, on the age of the person, and on the various riders taken by a person. So normally there is a concept in insurance which is called SU, which is sum under consideration. Now different insurers have got different formulas to calculate sum under consideration. Sum under consideration, for some companies it is sum assured 2 times of the critical illness if somebody has opted for the critical illness rider, plus let us say any other cost held by the concerned person. Some companies say that only if a person is having insurance from our company, that we will take into account for calculating sum under consideration. We will not take into account sum assured taken by other companies. Whereas some other insurance, they take into consideration all the other insurances. But the proposer or the life assured is supposed to reveal any prior insurances held by him or her in the proposal form. Because there is a questionnaire over there, do you have any other insurance? Yes, then of what amount? So one is supposed to reveal that. Because underwriters will see how much of sum assured is there now on this person in totality. In case the total sum assured is more than the so-called HLV of the person, human life value of the person, then they may say that no, you don't now require this much of amount of insurance. You should reduce your sum assured, or vice versa. So therefore, so this is also known as medical underwriting, and financial underwriting is also taken care of from this formula itself. For example, if the SUC, different companies have got different charts. If the SUC is say greater than 10 lakh, then such and such tests, A, B, C, D, they have different charts. And if the sum assured SUC is say between 10 to 20 lakh, these medical tests would be required. Under 10 lakh, maybe no medical test is required. So age, and even the age is also factored in many times here in these charts. So therefore it's a, you can say, matrix of medical and financial underwriting. And in financial underwriting, many times when there is a large sum assured, then other assets of the life assured is also looked into. What other assets this person possesses, what other properties and other assets, and why he or she is going in for a large sum assured. So financial underwriting is necessary in the case of larger sum assured. Now, when we had talked about HLV concept, then we had discussed that how much of insurance one person can have. There are 3 methods. One is HLV method, and second is needs approach method. Third is capital retention method. Then we had also talked about the thumb rule also. From the HLV, people have come out with thumb rules. Insurance companies say up to some ages, let's say up to the age of, from the age of 20 years to 30 years, a person can have 10 to 15 times of his annual income as the sum assured. Similarly, 30 to say 40 years, it can be 8 to 10 times, and so on. So that also can be seen under financial underwriting. So now next we would be talking about advance payment of premium. Now as we know in insurance, the premium is always paid in advance. For example, if one is going for an annual mode, so one needs to pay the annual premium at the beginning of the year, beginning of the policy year. Similarly, if one is paying a quarterly premium, then it should be given at the beginning of the quarter. So this is the concept of advance payment of premium. Now next we would be talking about the lapsation of the policy. Sometimes it may happen that a policy may get lapsed due to non-payment of the premium. So in that case also, this is the advisor's duty to advise his or her client whether to go on for non-forfeiture options. Even if the client has not gone for non-forfeiture options, which are paid up value, surrender value, or advance premium advancement from the surrender value, or converting the surrender value into term insurance. If the client has not gone in for these options, then the advisor can suggest the revival of the policy. So the policy can be revived by paying of the past premium arrears. No, this interest due to the lapsation of the policy. No. This is not the source of income of the policy. This is basically the expenses they have incurred. Basically the premium which was supposed to come, say in January, Now this premium has come in say December of that particular year. So that means the insurance companies had lost the income which this premium would have earned had it been invested somewhere. So therefore it's even in revival, even if they are taking interest, it's not an income for the company, still they would be incurring some losses. They won't say that we would have earned this much, we would have invested in some bonds or in government securities. No, they're just taking the simple interest, having interest which is the bank rate. So they don't take higher interest also, because otherwise it will further deter the clients to revise their policy. If the interest rate would be more, then people would not come back to the insurance company. Sometimes it happens that the policy is lapsed for the last 3-4 years. Then already the premiums would be accumulated, then the interest would also be accumulated on them. So then it becomes more cumbersome for the insured to revive the policy to give back, because normally due to financial problem the insured might not have paid the premium. Now further they have been accumulated. So they have to make it more attractive. Rather we have special revival schemes also. Insurance companies have to launch a special revival scheme sometimes, wherein they waive off any interest also sometimes in order to attract people. Like you hear in case of default of payments of electricity bills sometimes to farmers, and sometimes loan arrears, banks and all, they come out with special schemes. Okay, we are waiving off the interest part or something like that. The special camps are set up.
Government policy.
Yeah, sometimes government policy. Sometimes insurance companies, one fine day they come across, okay, so many policies are lapsed, so that's so much premium would have come to us. So let's send them letters. Okay, we are offering you a special package wherein you can revive your policy, wherein we will say waive off some part of the interest. Sometimes not full interest, but some part of the interest would be waived off. Or sometimes they say, okay, instead of paying all the previous premiums in arrears in lump sum, you give us an installment, but at least revive your policy. Give us 2 premiums out of say 10 premiums. So like that also. There are sometimes special revival schemes launched by the insurance. For any organization for that matter, not to talk about in life insurance companies, for that matter, if it is any organization, if one customer breaks away, or one customer doesn't stop his dealings with that particular company. So one customer has been lost. The revenue which would have come from this particular customer is lost. So in insurance also, when actuaries they make their premiums and when they sell their policies, so they have a certain estimate for the future that so much of premium would be coming in the say next 10 years, 4 years, because already we have sold so much policies. So they design their premiums for the future years accordingly, and they also do their valuations, actuarial valuations also accordingly. Accordingly they calculate their bonuses. Some of the policy holders, they lapse their policy, they do not pay the premium, so all those estimates which they had done, they go awry, they go haywire. So therefore the calculations sometimes are not conducive to what they had planned. So that way it's a loss. And anyway, insurance companies, because they are doing a lot of hard selling to sell their products, to push their products. So definitely in the midway, if some customer is lost, so that is also a lost sales for the future. In case a policy holder doesn't want to continue, the Life Insurance Act, the Insurance Act 1938 says that the insurer, a life insurer cannot forfeit the money paid by the policy holders. For example, let us consider the case that the policy was of say 20 years. Let's say the policy was of 20 years, term was 20 years, and the sum assured taken was of 2 lakh. Now somewhere in the midway, for example, this policy holder paid the premium for say 10 years, premium paid for 10 years. After that, due to certain causes, maybe due to some financial problem, maybe due to any cause, this policy holder discontinued paying the premiums. Now what will happen? The policy got lapsed. So does it mean that the premiums which this policy holder paid for 10 years, it will be forfeited? The insurance company will all just square up this money, or they will say no, you don't get anything. So that would be,
But he will get the money in a lesser.
but yeah, that would be injustice to the policy holder. So therefore Insurance Act has said that you cannot forfeit all this money of the policy holder. So then they came out with the options which are called non-forfeiture options. In case this policy holder does not want to continue the policy, in any case. So he has to be given a cash value. So this option is known as surrender value. This is more prevalent by the name of surrender value in our country. Otherwise, in other in European countries, in other foreign author books, you will find this as cash value. So this is also known as cash value. This is the cash value of the policy. What the person will receive in cash today. Suppose I am the person who has taken a policy. I am the life assured. I don't want to continue the policy. Okay, give me what cash I can get from this policy. So that is the cash value or surrender value. I want to surrender my policy. I want to surrender my rights. So therefore, you give back my money. So there is a formula for that. Then the second option is a paid up value. Paid up value means I as a policy holder want to continue the policy. I don't want the policy to discontinue. I want to certain sum assured on myself, but maybe due to some financial constraints, I am unable to pay for any further premiums. Although I have paid premium for 10 years. So I want to continue the policy. So this is an automatic option. I don't have to write especially to the insurance company. But yeah, that would be injustice to the policyholder. So therefore, Insurance Act has said that you cannot forfeit all this money of the policyholder. So then they came out with the options which are called non-forfeiture options. In case this policyholder does not want to continue the policy, in any case, so he has to be given a cash value. So this option is known as surrender value. This is more prevalent by the name of surrender value in our country. Otherwise, in other in European countries, in other foreign author books, you will find this as cash value. So this is also known as cash value. This is the cash value of the policy. What the person will receive in cash today. Suppose I am the person who has taken a policy. I am the life assured. I don't want to continue the policy. Okay, give me what cash I can get from this policy. So that is the cash value or surrender value. I want to surrender my policy. I want to surrender my rights. So therefore, you give back my money. So there is a formula for that. Then the second option is a paid up value. Paid up value means I as a policy holder want to continue the policy. I don't want the policy to discontinue. I want a certain sum assured on myself, but maybe due to some financial constraints, I am unable to pay for any further premiums. Although I have paid premium for 10 years. So I want to continue the policy. So this is an automatic option. I don't have to write especially to the insurance company. So insurance company will say, okay, fine, your policy is not going to become zero. Your policy's value. It will be, the sum assured would be reduced proportionately. For example, initially the sum assured was 2 lakh. So the formula for paid up value is number of premiums paid divided by number of premiums payable into the sum assured plus bonus. If any, if it's a bonus plan, that is if it's a participating plan, then there would be a bonus. So therefore, in this particular case, number of premium paid. For example, it was annual premium. So the person has paid 10 premiums for 10 years. He was supposed to pay 20 premiums because the plan is for 20 years. So 10 upon 20 multiplied by the sum assured 2 lakhs. Let us say it's not a bonus participating plan. So the bonus was 0. Let's assume. So this is 1 lakh, right? So the paid up value is 1 lakh. Now what does this 1 lakh means? This paid up value of 1 lakh means now this is the sum assured of the policy. This is the reduced sum assured. So the sum assured has been reduced proportionately. It is proportional to the number of premiums paid. So he was supposed to pay premium for 20 years. He paid for 50% of the time. He paid just for 10 years. So his sum assured has also been reduced to 50% from 2 lakh. Now from further on to 10 years, this person may not pay any premium. But the policy will continue till the end of 20 years. That is, for the next 10 years, the new sum assured would be 1 lakh rupees. If something happens to this particular policy holder in the next 10 years, then he is going to get 1 lakh rupees. His nominee is going to get 1 lakh rupees, or otherwise at the time of maturity at the end of the plan, he will get 1 lakh rupees. Otherwise he would have got 2 lakh rupees if he would have been keep on paying the premiums till 20 years. So therefore this was about the non-forfeiture options. So this is the advisor's duty to advise his clients on these issues from time to time. One has to handle the various complaints also. One has to also handle any claims also, because there is a separate department in insurance companies which is known as the claims department. So we'll be talking about the claims part in our next session. So thank you very much, participants.